So by the time you've come to this video about accounting for pensions and post-retirement benefits, you probably have realized that there's a lot of complication to this because the plan assets exist in the financials of the organization. A lot of things affect our pensions expense. We looked at all those 5 components in depth earlier, and some of the unexpected swings in our pension expense can be from sudden or large changes in the fair value of those plan assets, and that is a result of the factors of the stock market, what those plan assets are invested in, changes in actuarial assumptions that affect the amount of the projected benefit obligation. So this, honestly, we've seen this over the last couple of decades where people's lifespans have really become much longer. So their expected lifespan is longer than it was 20 years ago. With that has caused a change in actuarial assumptions, with the added benefit of people are becoming more and more conscious of things like GMOs, high fructose corn syrup, saturated fats, and all of these other factors. It wouldn't be surprising to see that actuarial assumptions are again going to extend the lifespan of the average person. So the question is, what is the potential negative impact on net income of those swings? Well, it can be really volatile, up and down and up and down and up and down and up and down. These are uncontrollable and unexpected swings in the pension expense. Because of this volatility, the profession decided to reduce that by using what's called a smoothing technique. Now, most of the time we tell you no management, no smoothing. In this case, because it is attached to the pension, is a slightly different. So to smooth some of the unexpected gains and losses on our plan assets, companies include the expected return on the plan assets as a component of the pension expense, not the actual return in a given year. And companies record asset gains and asset losses in an account called Other Comprehensive Income, combining them with the gains and losses accumulated in prior years. What's really interesting is that there are situations where it's actually the pension income that has propped up the financials of an organization. So this is why it's really important when we're looking at those pension expenses. Are they real, or are they being offset because that plan is operating so well? Companies report the liability gains and the liability losses in that other comprehensive income account, and they combine it with those from prior periods. They accumulate them and report them on the balance sheet in the stockholders' equity section. Now, that accumulated other comprehensive income, as it's taken on some of those gains and losses over the years, could get out of control if they are not offset by other gains and losses. To limit the potential growth, FASB requires what's called the corridor approach for amortizing the balance in the accumulated other comprehensive income account when it gets too large. The accumulated other comprehensive income account is considered too large and has to be amortized when it exceeds 10% of the larger of the beginning balance of the projected benefit obligation or the market-related value of the plan assets. So whichever one's larger, 10% of that. You can use any systematic method of amortizing the excess, but it cannot be less than the amount computed using straight-line amortization over the average remaining service life of all active employees. Amortization of the excess unrecognized net gain or loss should be included as a component of the pension expense only if, as of the beginning of the year, the unrecognized net gain or loss exceeds the corridor. So let's look at gains and losses. So here we have some data for Callaway Company's projected benefit obligation and their plan assets over a period of 6 years. So they had a projected benefit obligation of $1 million and market-related assets values of $900,000. That gives them the plus or minus corridor of $100,000 because the larger one is the projected benefit obligation and it's 10% of that. In 2017, there was $1.2 million in projected benefit obligation and $1.1 million in market-related asset values. Because the projected benefit obligation is the larger of the two, we take 10% of that, and the corridor is $120,000. In 2019, though, there's a $1.5 million projected benefit obligation and a $2.25 million market-related asset value. So the corridor in this case is $225,000 or 10% of the market-related asset value. So you can see how this works. We choose whichever one is larger and it's 10% of that. And that is your corridor plus or minus. So here is the corridor as it has actually been plotted out. It's a graphic illustration of the corridor that we just spoke about. Anything that at that point in time exceeded that corridor would need to be accounted for in amortization. So we're going to look at Shing Corporation, who had a projected benefit obligation of $3.1 million and plan assets of $3.3 million on January 1st, 2017. The net actuarial loss of $465,000 in their accumulated other comprehensive income. The average remaining service period of their employees is 7.5 years. So we are going to compute Shin's minimum amortization of the actuarial loss. So with a projected benefit obligation of $3.1 million and plan assets of $3.3 million, the 10% corridor is on the plan assets, so it is $330,000. There is currently an accumulated loss in the other comprehensive income account of $465,000. So there is $135,000 of this that is subject to amortization. And we divide that by the average remaining service of 7.5 years. And we amortize to the pension expense for each of those 7.5 years, $18,000. So let's use a pension worksheet to complete this. Here we have the information for Jackson Company, who adopted an acceptable accounting for its defined benefit plan on January 1st, 2016 with these balances. I'm going to pull this information up on another screen, just in case I have to refer back to it as we're speaking. And we'll begin working the worksheet for 2016. So the balance, January 1st, 2016, for the projected benefit obligation was $250,000. They had planned assets at $200,000, which means that there was a pension asset or liability of $200,000. They had service costs in that year of $16,000. Interest at a settlement rate of 10%. So 10% of the projected benefit obligation is $25,000. Actual return on planned assets was $18,000. An unexpected loss of $2,000. Sorry, an unexpected gain of $2,000. Contributions of $16,000. $14,000 in benefits paid. I'm sorry, the unexpected gain because they expect a return of $20,000 based on actuarial statistics. This gives us our journal entry, and an increase to our pension asset liability is $7,000. We have a $57,000 balance in our pension asset liability as of the end of the year. So you recognize to our pension expense $21,000, OCI gain or loss $2,000, pension asset liability $7,000, and cash $16,000. Now, if we continue on and we go into 2017, we start with those balances that were at the end of 2016. We have prior service costs of $160,000 from the plan amendment on 1/1/2017. Notice that it's going to that other comprehensive income account, giving us new balances of $437,000 for our projected benefit obligation to the plan assets at $220,000. We have $19,000 in service costs, settlement rate of 10%, so $437,000 times 10% is $43,700. Our actual return was the equivalent of our expected return. Remember, that was 10% that we were expecting, and we experienced that. We have amortization of our prior service costs of $54,400. We have contributions of $40,000, and benefits paid is $16,400. This gives us the following journal entry. And these balances. There's an increase that has been determined to be true to the pension asset liability of $217,700. 。 . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . to 217,700. My apologies. So the journal entry for 2017 is as follows. As you can see, that other comprehensive income account for PCS came out to 105,600. And then for 2018, we start with the end of 2017's information. We had $26,000 in service costs, 48,330. That is the 483,300 multiplied by the settlement rate of 10%. 24,000 return on assets. Gain or loss of 2,560.